This is a request to do the analysis of the Honest company, see what I think about it. That's what I'm going to cover in this video. I went to the store to look at the products, so let's see how it goes. If you're new to this channel, my name is Mariusz Konieczny. I run Microcap Explosions, a website dedicated to microcap stocks which are ignored and underfollowed by the investment industry. I also wrote about 10 books on investing, one of which is available for a free download at microcapexplosions.com. I also created valueinvestinguniversity.com, which is a free resource to make you a more intelligent investor. What you see in front of you is the website of what kind of products the company sells. So you have all kinds of creams, diapers, and lotions, shampoos, and things like this. And Jessica Alba is the face behind this company. She founded it. Some of the products that they sell are on the website. Some of them are in the retail stores. So let's have a look at my short tour of Target, which is where they sell the stores. So let's have a look. I am at Target looking at some Honest company products. So rash cream, body wash, yeah, shampoo, body wash. And then there's some other brands here. There's more. Faces and body lotion. So it's really only these two shelves. There's not much more. These are different brands here. Then there's more stuff here. Diapers, right? Wipes. Okay, so as you can see, I mean, they make products that are useful for people. They get those products get depleted, so people have to buy them over and over and over. Let's have a look at the stock price first. So ever since the IPO, right, the stock has been just down, 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 and as of the date of this video, which is April 28th, the stock is at $4. It's down almost 80%. Today was pretty flat, but the market was really good. The market cap of the company is 370 million US dollars. If we compare it to the income statement, most recent revenues were 318. So the company is trading at like what? 375 divided by 318. It's trading for a little bit over 1 times revenues. Because the company is losing money, we don't have any PE. But 1 times revenues, okay, yeah, all right, it's pretty reasonable. If we compare it to something, a competitor, which like literally when I was at the store, the competitor was just right next to it. Procter & Gamble, it's one of the competitors because they have many different lines of products. They have Procter & Gamble and Kimberly But I'm just going to look at this. So if you look at Procter and Gamble, they have a market cap of 380 billion. Okay, and the revenues for Procter and Gamble in 2021 were 76 million, right? So if you look at it, they say 380. Yeah, 380. So 380 divided by 76, it's trading at 5 times sales, right? And if you look at the stock chart, Procter and Gamble didn't really sell off at all, like during the sell-off, and that's what you get with amazing, stable companies. So you can say, all right, Procter and Gamble is trading at 5 times revenues, so honest company has the upside of being 5x or even more because it's growing faster, right? Yeah, you can kind of say that, but the problem is that Procter and Gamble, those revenues are higher quality revenues. Okay, why are they higher quality? Well, number one, they're profitable revenues because there is profit, right? So because there is profit, and if you go to the cash flow statement shows cash flow from operating activities of about $18 million, and capital expenditures are very low in comparison to the operating cash flow, which makes it a great business. And now that cash flow can be distributed as it is, dividends to shareholders, right? They get dividends. They also purchase shares. So this is a big portion of the cash flow was used to purchase shares. And if you look at the dividend yield, right, it's based on the current price is 2.25%. Also, so if we take the net income of 14 billion divided by 76, right, the net profit margin is about 18.5%. 18.5%. Now, why is this possible? It's possible because the cost of production, or the gross profit, if we take 37 divided by 76, gross profit margin is 51%. Okay, 51%, and then because the gross profit margin is pretty decent, you can actually cover the general and administrative, and you can actually have some kind of bottom line, which is, in this case, is about 18.5%. If you look at the honest company, and we start with cost of revenue or gross profit, we look at 109 divided by 318, that's 34%, right? So 51% for Procter and Gamble, 34% here. Now let's look at at least if they're getting better. 75, or let's 76 divided by 235. That was 32%, so it increased to 35%. So it's better, but it's nowhere near Procter and Gamble, which is understandable. Procter and Gamble is a huge company with much better distribution, much more cost efficiencies, much more bargaining power. They can probably get more money for selling their stuff wholesale to the retailers. They can negotiate better production costs. So they're going to have better profit margins, right? So if you look at something like the honest company, and you look at the stock price of what it was, I mean, it was trading at 5 times higher. So it was trading at like over $1 billion at the height. And at that point it had much less revenues, but it was still trading at 5 times revenues. The problem that we have with this company now is that the revenues are barely growing. I mean, look at it, 300 million to 318. The only reason you're going to say, I can invest in an unprofitable company like it is with them, is if you get growth. Because you get huge growth and you're like, you know what, we're going to sacrifice the current profitability because we're going to get a lot of growth and eventually we're going to be profitable. Now, they're not growing right now. They're not growing anymore because it's not that easy to grow in that space, first of all. Do you want to be competing against Procter & Gamble? That's really tough. But, so now, if you're not growing, then you better show me profits. And there's no profits. So now, like, do you want to pay a high multiple for an unprofitable company that's not growing? Well, no. So the decline in the stock price, it's pretty reasonable. Who wants to hold it? So now the next thing is, well, but they're going to grow. Okay. When they're going to grow, that's going to require what? Marketing. Huge marketing. That's going to require huge general and administrative to make it grow. And then the more you spend on these things, the more you're going to be unprofitable. So I can see the appeal. I can see the appeal in this company. It's not completely ridiculous. It's not like Tattoo Chef that has like it's ridiculous. I can see the appeal here because there's a percentage of the population that wants to buy the products from the honest company because of the ingredients, because of the integrity behind the founder and all that. I can see the appeal. And there's a lot of room that they can steal market share from the competitors. That's going to cost money. And unless they improve the gross profit margin, there's going to be nothing really left for there to be profits. This company is not something that I would invest in because I have better companies to invest in, but I can see the appeal. I can see the appeal, the products, it's repeat business, people need it. The competition is tough. So that makes the margins tough. And now with the inflation going up, they're going to get pressure from the manufacturers, and they don't have a lot of pricing power. They don't have any pricing power at the stores. So they're going to get squeezed from the stores wanting to get low price from them because the stores want to keep the prices as low as possible, and they're going to get squeezed on the manufacturing costs. So it's going to be tough to get higher margins. And in order to grow, to justify any sort of valuation, they're going to have to spend a lot of money on general administrative and on marketing. So I don't see them being profitable anytime soon. They're probably going to have to dilute at some point, and the market doesn't like dilution. So I don't know. These are my thoughts on this company. I can see the appeal. I just personally wouldn't touch it. So that's it.